To both of you gentlemen. Mark, I'll start with you. Odds they can pull off a soft landing?
Better than even. You talked about growth. I mean, you talked about GDP, but if you talk about jobs, there's a lot of growth, right? I mean, we created 400,000 plus jobs last month, 500,000 on average over the past year. That's going to slow, but that's, by design. And I would expect job growth monthly to get down to 100, 150 per month. That'd be consistent with stable unemployment. But when you're creating that amount of jobs, that's not a recession. That's a soft landing.
But if we see negative economic growth a few quarters in a row, that's a recession.
I don't know. No, not necessarily. The definition of a recession is a broad-based, persistent decline in economic activity. Broad-based is the operative word. So if you're sitting on the Business Cycle Dating Committee of the National Bureau of Economic Research, the official arbiters of recession, and you say, I got job growth, and unemployment is 3.6%, how can you call that a recession? So
you can't have a recession with 3.6 unemployment, I guess, is what you're saying.
Well, more importantly, the job creation. If we have job growth and job creation. The decline in GDP in Q1, that was trade, and that's because our economy is a lot stronger than everyone else's. It's also going to be trade in Q2. I think we'll get growth in Q3 and Q4, in terms of GDP. But in terms of jobs, I mean, at the moment, it feels pretty good.
I don't know, Scott, does that distinction matter to the markets, which it's another rough day, down 721 on the Dow, increasing talk on the street that it's going to be hard for the Fed to do a soft landing?
Well, I think that's certainly in the discussion. Now, I think there's the economic activity, and then there's the earnings response to that many equity investors are going to focus on. And here it's a little bit unclear in terms of how the timing of this is going to play out. We know that historically, economic activity will tend to lead earnings, let's call it by 2 quarters or so. So any fall off in economic activity through the second half of the year may not be fully felt in terms of what your 22 earnings trajectory is. It'd be more of a 23 situation that we need to contend with.
Mark, if employment is not our biggest liability, is it housing? And how worried are you about today's data and then the notion that housing leads?
Yeah, I was surprised by the home building numbers. I mean, the single family was down quite a bit. I thought that would hold up better because we have a very severe shortage of homes. And I think it's just maybe a gut reaction by builders saying, oh my gosh, mortgage rates are above 6%. That's more than double what it was just a few months ago. Let's just see how this plays out. And maybe they're pausing here a little bit. But I expect home building to home. But here, the most interest rate sensitive sector of the economy is housing, right? The Fed wants to slow the economy by raising interest rates. So what has got to happen? Housing has got to slow. We've got to see weaker activity. So this, again, is, I think, by design. If we're going to get a slowdown in economic growth, we need housing to weaken. I don't think we're at levels where, in terms of housing activity, that it's recessionary, at least not yet. And by the way, I don't mean to sound Pollyannish. Look, recession risks are awfully high, no doubt about it. But I don't think we should talk ourselves into a recession, which feels like what we're doing. And at the end of the day, a recession is a loss of faith. Consumers say, oh my gosh, I'm going to lose my job, and they pack it in. And business people say, oh my gosh, I can't sell what I'm producing, and they start firing people. That's a loss of faith, and we don't need to talk ourselves into this.
Scott, the other point, it's interesting. There was a poll, B of A did a survey asking what needs to happen in order for the Fed to either blink or relax. Inflation below 4, claims above 300K, S&P 3,500, or oil below 90. I wonder, which of those things do you think is most likely right now?
Well, I think the house view here is that oil is going to go down that path as we move through the tail end of spring and into summer. So I think that the energy price area is where you want to go immediately as a lead indicator of where the inflation trend can go. So I'd probably focus more on that. Again, what I would probably fall back on here is, in terms of this broader discussion, is that our view has been that the 3650 level would account for a mild recession condition, and we're kind of flirting with that level as we speak. The question becomes one of market pricing in something akin to a recession, but the recession odds, as Mark points out, are not 100% at this point. And so the question becomes, how do you navigate from here to said circumstance where recession risk does become closer to a recession reality?
Can I jump in? Look, the key here is oil prices. It's all about oil prices. I mean, the reason why we're in this mess is because oil prices, and you can actually connect the dots back to the European Union's decision to sanction Russian oil, which I get the sentiment, I understand. But that sent oil from 9,500 bucks to 120, 125 bucks and put everyone into the panic mode. So we got to get these oil prices down. That's the key here. And if we are a little bit lucky and we get some supplies from Saudi and the UAE and from frackers, we'll get those prices down and we'll be able to navigate through.
Shepard Smith here. Thanks for watching CNBC on YouTube.